You spent 25 years at the same company, and every year, a little bit more of your 401k ended up in your company stock. Now you're retiring, and that stock is worth a whole lot more than what you paid for it. Here's what most people do. They roll the whole thing into an IRA. It sounds like the go-to plan, right? What anyone would do? Not necessarily, because of the stock. In the wrong situation, that one move quietly costs you tens of thousands of dollars unnecessarily. I've got the strategy they missed and the real numbers in an example, all that more coming up. It's called Net Unrealized Appreciation, or NUA for short. And I'll be straight with you guys. This is one of those rules that's a little bit more complicated than it really should be, but when it fits, guys, it fits big. And the folks who get it right usually had someone catch it before they hit that rollover button. Here's the idea in plain language. If you own company stock inside your 401k, your company stock has two pieces to it. There's what you paid for it. This is your cost basis. It's the amount that you invested in it. And then there's the market value of your shares. That's what the stock has actually grown to. The difference between those two, what you paid and what it's worth, that's the growth. That's the second part. It's called your net unrealized appreciation. Normally, every dollar that comes out of your pre-tax 401k is taxed at ordinary income tax rates. It's your highest tax rate, by the way. But with net unrealized appreciation, you get to split those two pieces apart. You pay ordinary income tax on your cost basis, the small piece, and the appreciation, that gets taxed at long-term capital gains rates. That's the lower rate. And that's the whole play, guys. You're moving your biggest dollars off of your highest tax rate and into your lowest one. So when can you do this? You need what the IRS calls a triggering event, and there are 4 of them. You separate from service, you turn 59 and a half, or you become disabled or you pass away. For most of you watching, it's retirement, okay? That's what I want you thinking of. You leave the company and the window opens. But here's the key. The shares have to come out in kind, the actual shares, out of the 401k into a regular taxable brokerage account, not the cash and not into your IRA first. If you sell the shares inside your plan or those shares touch an IRA even for a second, the NUA is gone. This strategy is gone permanently. There's no undo button on this one. It can be a great strategy though. So let me put some real numbers behind it with a real example. Ron is 62. He just retired. He's got $900,000 of company stock in his 401k. And his cost basis, what he actually invested and paid for those shares over the years, is just $150 grand. So he's sitting on $750,000 of appreciation, net unrealized appreciation. So option 1 is the default, and you roll all $900,000 of that from your 401k into your IRA. Nothing's taxed today, but every dollar that comes out of it later is taxed at ordinary income tax rates. At a 24% tax rate, that's roughly $216,000 in tax over his retirement. That's option 1. Option 2 is the net unrealized appreciation strategy. The shares go straight into his brokerage account. He pays ordinary income tax on that $150,000 basis immediately. That's the biggest downfall of this strategy, and one that can be an ugly surprise who try to implement this strategy without the help of a professional. So tax on his basis immediately, 24%, say on that 150 grand, call it $36,000. Then, as he sells the shares over the next several years in that brokerage account, that $750,000 gets taxed at long-term capital gains. At 15%, that's about $112,500, okay? Add that up to total of about $148,000 for the net unrealized appreciation instead of $216,000. Guys, that's roughly 78 grand that stays in Ron's accounts instead of going to the IRS. And one more bonus, the appreciation piece isn't subject to the 3.8% net investment income tax. Now, let me show you where people blow this up. Number 1, it's all or nothing, okay? To qualify, you have to empty the entire account in 1 year. Move everything, every dollar, leaving a balance sitting in there on December 31st, and you lose the entire benefit, okay? That's 1. Number 2, if you're under age 59 and a half, that cost basis can get hit with a 10% early withdrawal penalty. There are exceptions, but if they don't apply, then watch out. And number 3, and this is the one I care most about, the NUA strategy hands you a tax reason to hold on to a single individual stock. And that fights hard against diversification. You do not want one company's stock price depending your entire retirement, whether it's going to work or whether it won't. Taxes should inform your decision. They should never drive them. And the flip side of that risk or that issue that blows this up is that oftentimes, as you're holding onto this stock inside of your 401k throughout your career, you might be tempted, or other investment professionals might be tempted to tell you to sell the investment and diversify, and then all of a sudden you give up the ability for this lucrative net unrealized appreciation strategy. So how this gets blown up is maybe too much concentration or too much diversification and not harnessing or being aware of the net unrealized appreciation strategy. And then blow up number 4, guys, the math doesn't always win. If your cost basis is high relative to the market value, say 40%, 50%, the tax that you'd have to pay up front can swallow up your savings. The lower your basis, the better the net unrealized appreciation strategy can work. Now, this strategy in the right circumstances can make a ton of sense, saving tens of thousands of dollars. But notice that this decision, it touches so many parts of your financial life, your taxes, your investments, your retirement income plan, even your estate plan, because the appreciation doesn't get a step up in basis to your heirs if you hold it like most assets do. This is exactly why we look at all 6 areas of your financial life together in one plan. Comprehensive financial planning, because pulling the NUA lever, it changes your Roth conversion window, it changes your income during gap years, changes what your kids will inherit. You cannot decide all of this in isolation in a vacuum. You need one plan. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.